So, according to Wall Street analysts, this is one growth stock you should be buying hand over fist. Looking at the analyst price targets of 29 Wall Street analysts, this growth stock average valuation fair value is $125.52. It's currently trading at $100.30. And if you look at the recommendation rating, it's recommended at a 2, which is a buy. So what is this growth stock? It is the Walt Disney Company. And I agree with Wall Street here in their assessment of this company and recommending it a buy. I would also recommend this stock a buy. I'm going to talk about why I think that's the case in this short video. So, looking at the Walt Disney Company over the last 5 years, what we notice is the big fluctuation from the pandemic, right? It had to shut down its theme parks temporarily. That caused revenue to collapse, and now it's recovering from that blow from the pandemic, and revenue is above where it was before the outbreak, 84.4 billion. And I suspect this is continuing higher for at least the rest of 2023 as consumers just unleash this pent-up demand for away from home experiences. Disney is benefiting strongly from that trend. What has yet to recover for Disney is its operating income over the trailing 12 months. You look at the operating income and it fell during the pandemic, but it has not recovered completely yet. It's recovered strongly all the way up to 6.56 billion, but it's only halfway there from recovering completely to where it was before the outbreak. And I suspect this will happen over the next 4 to 12 quarters, where it will recover back to its pre-pandemic levels of operating income. Of course, within the outbreak of the pandemic, Disney also had a major strategic change, investing in its streaming segment. That also was a big decliner of its operating profitability. Management has said it expects its streaming segment to be profitable by fiscal year 2024, so by next year. And so that's another reason why I think Disney's operating profitability will take a big jump next year, because the streaming segment will go from a negative to a positive, and that will boost its operating profitability, while the theme park segment is already more profitable than it was before the outbreak. The theme park segment has reached levels that's more profitable than before the outbreak, even though it's still not back at full strength, right? Consider that Disney has a theme park in China, and the economy in China is just now reopening just a few months ago. So that its theme parks in China, in Hong Kong, in China, in Japan, those are just now recovering, and they're nowhere near full strength. And so as those recover, and the theme parks in the US are thriving, they are absolutely thriving, profit margins above where they were pre-pandemic, parks are full, reservations are full, everything is booming for Disney in that regard, but it's getting better even. So that's something to keep an eye out for and look forward to if you're looking at Disney. And I agree with Wall Street analysts on their recommendation. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. And one of the major reasons is the valuation. Disney is trading at a forward price to earnings ratio of just 18.3. This is the lowest this stock has traded for in about a year and a half, right? You haven't been able to buy Disney stock at this valuation, or you've had a few opportunities, but not very many, to buy Disney stock at this valuation with the strong tailwinds behind it. So, yeah, I agree with Wall Street. I think Disney stock is one that you can be buying right now, based on analyst expectations and their recommendations. All right, so that's all I've got for this video. I really appreciate your viewership. Thank you so much for watching, and I hope I will see you again soon.